all the major indices are down. And of course, we want to look at the NASDAQ as well, because the NASDAQ is really what's carried us, right? That's the home of these magnificent, amazing companies, amazing stocks. And I got to tell you something. If they start to falter, because they've carried the S&P, but they certainly have carried NASDAQ as well, maybe we are in a lot of trouble. I want to bring in Simplify Asset Management, Mike Green. Mike, I want to start with your note on tech stocks. Yep. All right. It's a little bit scary here, right? Sticking with the Ghostbusters theme. So tech stock growth is going to get destroyed when rates move higher. That's scary.
Well, that is scary, but it was actually kind of an ironic tweet. So the concern that people have generally expressed is this idea that much higher interest rates are really what's going to change the character of the economy and change the character of the market. We really didn't see that. So coming out of 22, right. into 23, we saw interest rates maintain at much higher levels and stock prices didn't really retreat. Unfortunately, I think that sent the message to everyone that it doesn't matter, right? That the U.S. economy can sustain with much higher levels of interest rates and that inflation is going to be really hard to fight down. You've been touching on exactly this point. It's a bifurcated economy. Those who have cash in the bank, they're feeling great. Their assets are suddenly earning money. Those who have borrowed money, those who have taken out car payments, those who are looking to buy a home, they're hopelessly lost in this environment, and we're starting to see that stress build.
Are we starting to see a realization, or at least a willingness to discuss that maybe rates, although we have one of the more aggressive rate hiking cycles in history, were never restrictive enough? Despite the fact that we were told that famous pain speech that Powell gave on Jackson Hole, he used the word pain, the market collapsed. He said, be ready to endure pain. Maybe there hasn't been enough pain across the board, and if that's the case, would the Fed have to go back to the drawing board and actually hike rates from here?
So I don't think so, but I think part of what's happening is that there is not one right rate, right? The rate that works for you may not work for me. The rate that works for small business that's now facing the realities of competition coming in from large, cash-rich, publicly traded companies. If you're running your local Mexican food restaurant and you're competing against Chipotle, well, Chipotle has resources and has the ability to offer resources to attract employees and do things that you simply can't do. Their cost of financing is a fraction of what you see in the small business area. And it's that small business. If you look at the NFIB reports, the small business reports that are coming out of Bill Dunkelberg's group, they're telling you things have never been as bad as they are right now.
Right, and they also tell us that they're raising prices.
They are being forced to raise prices in part because costs have not retreated in the way that they have. But small businesses don't really have the pricing power that the national chains do or that others may end up having. If Apple raises prices on iPhones, by and large, we're going to pay it, or more accurately, Verizon or T-Mobile are going to pay it. The simple reality is that the local small business is actually seeing decreasing attendance. The local restaurant is seeing lower attendance. And these numbers are starting to retreat in the economy.
So, Mike, listen, we've been somewhat spoiled. I think I lost track, 120 trading days, maybe more, without a 2% correction. Every time there's any red on the screen, people kind of lose it a little bit, right?
Yep.
So, is there a point, though, where, and I call it the proverbial snowball becomes a boulder? Is there a point where now on the downside it takes on a life of its own? In your mind, where selling can beget selling?
So I think that's a great question, and that unfortunately really does characterize the market that we're experiencing right now. We've had an explosion of people using option strategies to either generate income or to change the profile of the underlying return. We hear about zero data expiry options, et cetera. When you do that, you're actually changing the behavior of the market because it's creating positions under which dealers are going to hedge in the opposite direction of the marketplace. So if I sell a put, that's protection that the dealer now has. They don't have to think about it in the same risk framework. But if I start stopping out, if I'm suddenly forced to buy that back under distressed conditions, then the dealer's position will change and the market can start to snowball. And it does feel that number is probably down around 4%. Okay. But it has to happen fast.
So then before I let you go, I mean, there's a lot of things out there. We just ended earnings season, not impressed so far, right? JP Morgan and the rest. We've got the situation where inflation is not slowing to the rate that everyone thought or were promised. And then we're losing confidence in the system, the credibility of the numbers. So what's the most pressing concern for you?
Well, for me, the most pressing concern is actually happening in the employment markets and in the small business markets. So we're seeing the New York Fed just released its survey a couple of days ago in which they're highlighting that those at the lower end of the income strata are finally starting to really begin to worry about their jobs. The fears about losing jobs has exploded. The other thing that I'm paying close attention to, I'm less worried about the inflation component, candidly. because it's happening in an understandable cycle. This last inflation print that we got was heavily skewed by the dynamics of motor vehicle insurance, which I'm sure most of your listeners have experienced on a first-hand basis, and also the dynamics of motor vehicle repair. But those two components accounted for a massive dynamic of it. Now, if you remember, the entire inflation cycle was kicked off by used car prices spiking. Right. So when used car prices spike, you have to replace that car under insurance. It costs you more money. The insurance company starts to raise its prices. But that doesn't translate through the next one. The higher insurance cost isn't going to get you to buy another car. It's going to do the exact opposite. So I think we're towards the end of this. I think it's towards the end of correcting itself, but there's an awful lot of problems out there that have now been created, both by the failure to address inflation early and probably by our keeping rates at these levels where it works for some but doesn't for others.
Great stuff. Really
Thanks very
appreciate
much,
it.
Charles.
Thank you very much.